Hello, and welcome to Crescent Private Wealth's first quarter 2026 market report. My name is Omar Bassal. Today we'll be discussing the following topics. We'll start with a discussion on economic news. Then we'll look at de-dollarization. What does that mean? What does it entail for investment portfolios? We'll discuss US stocks, followed by a discussion on non-US stocks, and we'll end with a discussion about precious metals. In the month of December, the US economy added 50,000 new jobs. This was actually below expectations. Despite the lower than expected job growth, the unemployment rate fell to 4.4%. So, how does that work? The unemployment rate looks at how many people are looking for work and compared to the entire labor force. So, if someone stops looking for work, they're effectively not counted as being unemployed. So, in the case of the unemployment rate, it fell from 4.5% in November to 4.4% in December, partly because new jobs were created, but also partly because some people decided just to leave the labor force, stop looking for work. Inflation in December rose 0.3% for the month. The annual rate of inflation is now holding steady at 2.7%. That's a little bit above the central banks or the Federal Reserve's target range, but not worrisomely high. A partial government shutdown is possible given a funding deadline of January 30th. So we saw a government shutdown in October, which was very disruptive. Some essential government services have been funded through September 30th, but many others have not, and they need a bill to be passed by January 30th. Because of some of this political strife that's happened recently in Minnesota, Democrats have signaled that they may not pass that without some changes or without withdrawing funding for the Department of Homeland Security. All up in the air, and therefore we can't know for sure if we're going to have a partial shutdown or not. This chart shows you let's talk about the upper portion first. It's showing you the corporate sector employment compensation as a percentage of GDP. So what does that mean? Basically, it's a measure of people's wages compared to GDP. And what you can see is that in the 1950s and 60s and 70s and 80s and even the 90s, it was pretty steady. But then you can see this big decline. And what's really happened is that people's share of the pie in terms of wages has been falling. And it's been falling because of increased corporate power, because of lobbying, because of the decline of unions. These factors have resulted in people being paid less than they otherwise could be paid. In other words, corporations could pay them more, but they're able not to. And unfortunately, that can affect spending. It can affect, more importantly, civil cohesion, because people can hear positive news happening in the market or the stock market rising, but they don't feel better off. And they don't feel better off because most people in America get paid through wages, and those wages have been suppressed, unfortunately. That can't go on forever. Either you need to have populism, which can force companies to pay more, or worse. I don't want to talk about worse, but the below chart is showing you the corporate sector profits as a share of GDP. And so you can see here, it looks like a mirror image of the top. You can see it's just been rising steadily since the early 2000s. Again, corporations have been able to make more money, and because of the decline of unions, they don't have a group of people that are unionizing to push for more wages, and therefore they can pay less. So it's been good for owners of companies, such as shareholders, but it's been bad for people spending. And most people receive their money through wages. So it's been bad overall for most people, but very good for corporations. Let's talk about de-dollarization. First, what is de-dollarization? De-dollarization refers to the deliberate process of countries reducing their reliance on the US dollar. So the US dollar is the reserve currency. It's the most most important currency globally today. But now countries have had second thoughts about holding US dollar assets or US dollars and are choosing to buy other assets instead. So the weaponization of the US dollar uh, followed Russia's invasion in Ukraine. So basically, once Russia invaded Ukraine and the US put all sanctions and froze assets of Russia that were in dollars, other countries felt that having dollars was a risk because in times of distress or if there's any conflict with the US, those dollars may not be available to us. So that's been spurring many countries, especially what they call the BRICS, the Brazil, Russia, India, China, South Africa, to look at other options because they're worried that, hey, even though we hold US dollars or US assets, because at the same time, if you have a US asset, the US government can still control it. They said, let's look at other assets instead, other denominated assets such as gold, such as other other currencies or other or even stocks that are in other countries. Recent U.S. political actions have given countries pause about holding U.S. dollar denominated assets. So let's look at some headlines. The first headline I'd like to share with you is Trump threatening Canada with 100% tariffs over pending trade deal with China. So this is kind of new. The US is upset with Canada doing some kind of agreement with China. It's not like a free trade deal, it's just some lowering of trade barriers. But because the US is unhappy with what Canada is doing with China, it's threatening Canada. So obviously, Canada does not like that. The next headline here: Trump backpedals on threats against Greenland, but allies say damage has been done. So obviously, the U.S.'s insistence on acquiring Greenland, the easy way or the hard way, has really again concerned others because it seems to be that the rules-based system set up prior to or post World War II is no longer in place. It seems to be now it's like might makes right. So again, that is something concerning to countries. In the U.S., the I don't know if you want to say kidnapping, but the taking of Maduro from Venezuela was praised. But outside the U.S., people were somewhat concerned because what jurisdiction, what laws, what rights did the U.S. have to take a foreign leader? And I don't want to get into a political discussion, but rather I want to focus more on the way other countries interpret these actions. The last headline I'll share with you is the Department of Justice launching a criminal investigation into the Federal Reserve, into the chairman of the Federal Reserve, Jerome Powell. Again, this is unprecedented. The Fed has been around for 110, 115 years, and it's never had to deal with this kind of campaign, so to speak, where charges are being brought or forces trying to be applied to make the Fed kind of do what the president would like them to do, which is lower interest rates. So, side note, the U.S. The president doesn't control interest rates because if a president controlled interest rates, he could simply lower it prior to elections and then raise it after the elections. In other words, you could use interest rates as a tool to affect the economy for political reasons. So for that reason, the setup of the Federal Reserve is, or not only the Federal Reserve, other central banks in the world, is that they're supposed to be independent from the political class because otherwise the inflation is not the primary objective. The objective could be votes or other political ends, not the health of the economy. So this pressure campaign again causes other countries to pause. Hey, we're worried about the dollar. It may be inflation will be higher in the future. If the U.S. starts to be able to control, if the president controls interest rates, not for inflationary purposes, because if you're holding dollars and you're sitting in Thailand, you don't want the value of the dollar to go down because of inflation, which could happen if the president were in charge of interest rates. So here are some headlines we can see kind of the results. The first headline is that China dumps more U.S. debt, buys other assets as Trump targets Powell. So you can see here the Beijing's Treasury holdings. These are holdings of government debt, U.S. government debt, hit a September 2008 low. So clearly they are reducing their exposure. Another headline, largest European pension fund, ABP, is cutting back U.S. Treasury holdings. And then a third headline, Danish pension fund is exiting their entire U.S. Treasury holdings. These are, it's not a major blow for the Treasury market. The Treasury market is trillions of dollars of size, but at the same time, it's not healthy. Not a good sign when like China and Europeans are saying, "Hey, maybe we don't want to hold U.S. assets." Denmark is saying, "Hey, we just had a big dispute with the U.S. Maybe it's still ongoing. Do I really want to be holding a lot of U.S. assets in this environment?" Let's talk about U.S. stocks. So U.S. stocks returned about 17.9% in 2025, led by the technology sector. Great performance, but there are headwinds that might constrain returns this year. While the Fed is cutting interest rates, which is a positive, long-term interest rates have been rising in response to the deterioration of the U.S. financial health, attacks on the Fed, et cetera. So the US financial health has been weakening, unfortunately, because of just dramatic spending that's in excess of revenues. And every time that happens, there's a deficit. And when there's a deficit, that gets added to the debts, and then the debt grows and grows. And then interest on the debt starts to occupy a big portion of the government budget. And it doesn't, that cycle is very not a positive cycle, because the government has to spend more and more on servicing debt than actually building bridges or doing things that are more constructive for the economy. And so in the long term, it really constrains an economy, and it can also affect asset returns. This is an interesting chart. So there's something called the presidential cycle, which just looks at how US stocks perform in the first year of a presidential cycle, and the second year of the presidential cycle, and the third year, and the fourth year. And believe it or not, there seems to be a pattern. So the first bar is showing you that 61% of the time, the first year of a president's term, is the stock market is up, and that's what happened in 2025. That was the first year. On average, the return has been 7.9%. Obviously, we did much better than that. We did 17.9. Second year is actually the weakest year of the 4-year cycle. So you can see here that only 52% of the time is the U.S. market up, and the average return is about 4.6%. So if you look at Biden, 2021 was his first year in office, 2022 was his second year, 2022 was actually the worst year in terms of the stock market for him. It was a big negative year. So you can see that cycle did hold. We don't know if it will hold this year, of course, but it could. The third year of the presidential cycle, which would correspond to 2027, and for Trump, is typically the best year. You can see about 90% of the time the market's up, an average return 17%. And then the fourth year, markets are typically up, but the return is much lower, 7.3%. So, why does this happen? It happens because of elections and presidents' priorities, and what they can do and implement. And, so there is a logic to why this occurs. It doesn't always have to occur. So there can be other factors, such as like COVID, obviously a war, that can change these dates. But in any case, it's interesting to keep in mind what history has shown. This is showing you the issue about government debt as a percentage of GDP. So this simply shows you US, China, and Europe with respect to their levels of debt compared to their economies. And what you can see here is that the US's government debt is the highest among these three. And so again, that is a risk factor, because it can constrain the government's ability to do other public services when they have to spend so much on servicing the debt. And then in very bad situations, you can get currency crises, you can get like massive inflation. Like there's different ways that governments can get out of this problem. None of them are really good. But they can be default, they can be inflation, they can be what's called financial repression, where they basically push interest rates to very, very low levels, which has been happening in Japan for many years. So the bottom line is that these dynamics are not healthy and potentially will affect market returns. Let's talk about non-U.S. stocks. So the global ex-U.S. stock returned about 33% in 2025, about double the return of the U.S. Why did that happen? Well, partly they have much lower valuations, and they have not performed as well in previous years. Another reason is that the dollar weakened, the US dollar weakened significantly in 2025, and that added additional returns for US investors. For anyone who's investing in the US dollar, they're getting additional return because the yen or the euro or these currencies appreciated. So you get the return of the stocks, but you also get the return of the currency. And then there's the entire AI ecosystem that's happening in emerging Asia. So all of the money that Meta, Microsoft, Amazon, not all of the money, but a good portion of the money that they spend, a lot of it is going overseas to Taiwan and Korea. These countries are actually manufacturing chips or manufacturing cooling. So that has benefited those economies. Investors are increasingly seeking out alternative homes for capital in light of the uneasiness with U.S. economic and foreign policy. So obviously tariffs have been well known. The threats against Greenland, attacks on the Fed, all of these things are causing people to look at international stocks. So let's just look at actual data to confirm what we're saying here. So this is showing you the amount of money going into an emerging market ETF, one of the largest in the market. And what you can see here is that in the last 3 or 4 months, it's been like record amounts of money flowing into emerging market stocks. So people are saying, let's own, Brazil, and let's own India or China, let's own Korea, Taiwan. Those are the markets that we want to be owning. They feel more comfortable in those economies than they do holding maybe U.S. or other assets. Finally, let's discuss precious metals. So precious metals, primarily gold, silver, platinum, experienced strong performance in 25 and even so far in early 2026. So to give you some idea, in 2025, gold appreciated 65%, silver was up about 150%, platinum up about 128%. And you can see here that in the first few weeks of January, gold's risen 17%, silver 52%, platinum 40%. So just amazing returns. So precious metals. So the reasons for these appreciations are basically what we've been discussing throughout this presentation. The uneasiness with the U.S., the attacks on the Fed, the Greenland, the tariffs. All of that causes people concerns, and they don't want to hold dollars. What do you have to buy? Well, they're not going to buy rubles, Russian rubles. They're not going to buy something that's really risky. They're going to try to buy something they consider safe. And so gold is the ultimate safe haven. It used to be like treasuries, but again, because of U.S. treasuries, U.S. bonds, but because of what the U.S. has been doing, people are no longer feeling comfortable buying treasuries. They want to buy something else. Precious metals prices are responding to several factors. The central banks diversifying from the dollar. We discussed that in the previous months, geopolitical tensions and short-term U.S. interest rates. So just to give you some perspective, this is a chart of silver from 1996 through 2026, or through the first few weeks of 2026. So you can see here just kind of hockey stick there. Now, obviously, silver is responding to not only the geopolitical factors, but also there's some scarcity issues as silver is being used in EV, electric vehicles, and solar panels, and the AI build out, the data center build out. So there is a demand factor here, but just to show you kind of perspective here of 30 years. This first headline shows you, or the headline here in this chart shows you, decoupling from the dollar, India sells U.S. treasuries and buys gold. U.S. Treasury holdings dropped to 5-year low. So just a small headline, or the small from the article. The decline in U.S. bond exposure has coincided with a substantial increase in India's gold reserves. The Reserve Bank of India's data shows that India now holds approximately 880 metric tons of gold, following aggressive purchases over recent years. Gold currently accounts for about 14% of their foreign exchange reserves, valued about $700 billion, as compared from 9% last year. Now, obviously, part of that increase is because gold prices went up, but part of the increase is because of the additional purchases by the Reserve Bank of India. We thank you for your time and hope you found this beneficial, and look forward to updating you on for the next month's report. So thank you very much.